Hello friends, welcome to AARDHA. In this video, we will see what are various types of mutual funds and which one best suits your needs. First of all, why understanding various types of mutual funds matters because wrong choices will give wrong outcomes. Choosing the wrong fund type can harm your returns or add unnecessary risk, which you might not be prepared for. Match fund to goal. Different fund suits different goals, risk levels, and time horizons. Also take SEBI-aligned decisions. Understand types of mutual funds helps you make informed regulation compliant choices. Now let's see five main categories of mutual funds. Equity funds. Equity funds basically mutual fund amount will be invested in the equities listed in the stock market. Large cap, mid cap, small cap, ELSS are various type equity type funds. Debt funds. In debt funds, amount will be invested in liquid funds are corporate bonds or gilt, meaning government bonds. This is for stability and income. Here, equity funds, your money, if you want it long-term growth, then go with equity funds. If you want stability and income, go with debt funds. Whereas hybrid funds, here this follows balanced approach. Uh, Part of amount will be invested in equity and remaining part might be invested in debt funds. Aggressive, conservative, dynamic are various types of hybrid funds. Solution oriented funds. There are funds like retirement funds, children's funds, like some funds have lock in, 5-year lock in, etc. These are for gold based investing. Other categories are like index funds, fund of funds, international funds, etc. First, let's see what equity and debt funds are. Equity funds, liquidity, large cap, mid, small cap, ELSS are various types of equity funds. Here, large cap amount is invested in big stable companies. This is beginner friendly and as there is low volatility. Whereas mid or small cap growth companies amount is invested in mm, slightly new new companies are which have less market cap, less history, right? So here risk is slightly higher and this is suitable for long term goals. ELSS gives tax saving under ITC, but here there is lock-in of 3 years. Here returns might be from somewhere around 10 to 15%, but risk is higher. Whereas debt funds, uh, liquid funds, corporate bond, gilt funds, or etc. are various types of debt funds, right? Now let's see about liquid funds. These are ultra short-term funds for parking your money. Here you can withdraw the money without any penalty, uh, even within weeks. After a week or two, if you need your money, you can withdraw this. Whereas corporate bond funds invest in AAA companies, here 1 to 3 time horizon will be there. Gilt funds 100% government securities. So here zero credit risk as government will pay your money. Here returns are 4 to 8%. Risk is low to moderate. Now let's see hybrid fund and index investing. Uh, let's first see what aggressive hybrid is. In aggressive hybrid, as the name indicates, most of the uh, amount, like up to 65%, is invested in equity, and other amount is invested in debt. Here, moderate risk and balanced growth it has. Now let's see conservative hybrid. As the name suggests, 75% of about 75% amount is invested in debt, and other amount is invested in equity. Here, low risk. This suits for low risk investors. Dynamic allocation. In dynamic allocation, auto adjust mix all weather flexibility, meaning if there is scope for equity growth, then most amount will go to equity. If there is volatility, then most amount will go to debt. So dynamic allocation is all weather friendly. Here returns for hybrid funds may vary from 8 to 10%, and time horizon may be 3 to 5 years horizon. Now let's see index funds. Index funds, these track Nifty 50, Sensex. So passive, these are passive funds and also low cost. Here fund managers has a very less work, so they may not charge you much. ETFs like index funds, these are like index funds but traded like stocks in the exchanges, need demat account. These are ultra low cost funds, no manager bias, best for 10 plus years. So if you have very less or no knowledge about mutual funds, start with index funds and ETFs. These are the best, as returns does not depend on the type of fund and etc. It just depends on growth of the Indian economy. Now let's see mutual fund taxation. For equity funds, up to 15% tax will be there. But here less than 1%, less than if it is less than 1 year, 15% tax will be there. If it is more than 1 year, above 1.25 lakhs gains if you are having, then 12.5% is the tax. Debt funds, short-term capital gains is as per slab, whereas long-term capital gains is 20% plus indexation. For hybrid funds, depends on equity. If greater than 65%, then equity rules apply. If equity is greater than 65%, then equity rules apply. Tax saving tip. This is a very good tip. Hold equity funds greater than 1 year to get benefit from LTCG exemption up to 1.25 lakh annually. Now let's see various critical cautions before investing. Don't confuse fund names. Balanced advantage is not balanced fund. See, balanced fund is different from balanced advantage fund. So a small variance will be there. In balanced fund, in balanced fund, proportion between equity and debt is fixed, whereas in balanced advantage fund depends on the market conditions. It varies. So these are two different funds. According to me, balanced advantage fund is better if you want your returns, your funds to be adjusted based on market conditions. Check expense ratio. Higher costs eat into returns over time. Go for very less expense ratio. Uh, Here, better to invest in direct funds. If you invest in direct funds, then expense ratio will be very less. ELSS has 3 year lock-in. Solution oriented has 5 year lock-in. So be aware of lock-ins also. If you by mistake invested in ELSS fund without knowing the name, then your funds will be locked. Debt funds carry risk, as companies may default the payment, and international funds face currency and geopolitical risks. ETFs need demat account and brokerage, so watch liquidity issues. Exit load apply if you withdraw before specified period. Also, nominee is not a legal head, so ensure proper estate planning clarity. Use only SEBI registered platforms and AMCs for investing. Report fraud via National Cybercrime Helpline 1930. And the most important thing is match the fund to your need. There is no single best mutual fund, only one best suited to your goal, risk profile, and time horizon must be selected by you. For long term goals, go with equity funds. For balanced, go hybrid funds. For short term safety, use debt funds. Start simple, start smart. Don't chase past performance. Match fund type to your specific need and investment. Invest systematically. Thank you.